Hello everybody, my name is Nicole and I'm a technical analyst and private investor. And today I thought I'd look at the yield on certain key Treasury products because there's quite a lot of hype at the moment about potentially higher inflation, especially in the United States, and higher yields. And yes, the yields have backed up quite a bit, but I'm trying to get a sense of perspective for you here. And the problem with the higher prices is that believe it or not, it's nearly all concentrated in food, both eat at home and eat out, as they call it in the States. And also, very interestingly, in the States, quite big price rises in the cost of second-hand cars and trucks. So it's a very concentrated type of inflation and inflation threat, something which the Fed, in their minutes, which were published yesterday from their FOMC meeting in late January, have decided to look through, as they call it, like, let's just put up with this and see how we get on. And I think they're absolutely right, because we've gone from sort of Robin Hood mania to now we've got fast freeze in swathes of the middle of the United States. So I think they're right to do so. So without further ado, let's look at the yield on the US 30-year Treasury bond. Now, this one is very important in that this is what US mortgages are based on, okay? And there's been a substantial drop over the last month in the number of new mortgage applications, unsurprisingly, because you can see that not only has the yield broken through the downtrend line, it's above the high that we made in June last year at 1.76%. It's just gone through the 2% psychological level, but we are at the record low of 2016, and we're just above the record low of 2019. I think this is probably about to fizzle out at this 50% retracement level, the halfway point between last year's collapse in the first quarter and the downtrend that started in late 2018. So I think what we're seeing here is the law of tiny numbers. We've gone from 1% to 2%, so we've doubled the interest rate on this piece of paper. But that's just because it's quite easy to get from 1 to 2, isn't it? And what we're seeing here is the natural ebb and flow in a market rather than a new trend to higher prices. Now, the reason that I am more confident about this view is look at this 2-year chart. Now, again, it's a weekly chart. And I've put on the mean regression since June 2020. And you can see that we're currently trading 1 standard deviation below the mean regression and almost at the record low that we hit last year, which is just over 10 basis points. We're now, what we're looking at here is the difference between nothing, next to nothing, and infinitesimally small moves where we're working to 4 decimal places now, 4 decimal places. So you can see how finely tuned this all is. We had a decent spike high last week, a real sort of like rejection from this 1 standard deviation above the mean, and we're at the lows. I think the thing is building for an imminent downside break, taking us close to 0 and potentially to negative yields on the 2-year. And now moving on to my third and final chart. It's the British equivalent of the 30-year, a 30-year gilt. And again, you can see, like the bond, it's broken the downtrend line. It's currently trading at the record low of 2016, above the record low of 2019. And as somebody as old as I am, I cannot believe that a gilt yields almost half of what a US Treasury does. But I think we've come to a sudden halt, and we're going down again in yields here too. Good luck, everybody.